I've started lecture. I said I'm mad. You are affecting what I'm doing now.
Please mute your mic, please.
Okay. Good evening to you all.
Good evening.
Okay. Good evening, everyone. Good evening, everyone.
Good evening, sir.
Yeah. We are meant to look into the aspect of Ipsa, not everything, because there's no way I will lecture that parastatals that I will not apply the principles of some Ipsas. I will now need to look at those Ipsas that are necessary now relating to that topic I wanted to take, that you need to have idea of, and also to solve some questions that are practical questions relating to ICANN. The Ipsas is being grouped into 4. We have Group A, Group B, Group C, and Group D. I'm going to take Group A and C. Exactly. While the other lecturer will take Group D, Group B, and D. Exactly. Now, based on what we now have here, I will take Ipsa 1, I will take 2, 3, Ipsa 11, 12, and Ipsa, I will also take 13, and I will also manage to take what? Ipsa 17. If we can be, I don't know whether we'll be able to finish everything today, but if our venture was able to finish it, then we need to do it one after the other. Now, looking at it in an understanding manner, International Public Sector Accounting Standard, that is what IPSA is all about. The introduction, this is how they got about it. Formerly, the Public Sector Committee, PSAF, is the board of IFAC, International Financial Accounting Committee, formed to develop and issue under its own authority International Public Sector Accounting Standard, an highly quality global financial reporting standard for application by the public sector entities and other than government business entity. The objective of this is to serve the public interest by developing high quality public sector financial reporting standards. That is the purpose of this. And who are the members? They have 18 members, 12 of which are nominated by the member of the board. All these ones, they are not area where we are meant to concentrate on, but you can read those ones on your own. Then, on that aspect, there is what we also call due process involved. The study of national accounting requirements, considering the pronouncement issued by the International Accounting Standard Board, national standard setters, regulating authority, and authoritative body, professional accounting board, and other organizations interested in the financial. All these are those who make up the committee. Those ones you can also look into that. But our area of interest as of today, the provision of Ipsas 1, what is it all about? Ipsas 1 is presentation and preparation of financial. How are we meant to prepare that? The aim of this standard is to describe the format in which general purpose financial statement should be prepared so that it will be compared with the entity financial statement of previous period and their financial statement of other entities can have a kind of uniform in treating accounting standards. That is the purpose of Ipsas 1, preparation and presentation of financial component of financial statement in the public sector. How does it look like? The first one is statement of financial performance. When we talk of component of financial statement in the public sector, the first statement is statement of financial performance. We have statement of financial position. We have statement of cash flow. We have statement of net assets or change in funds. Statement of net assets or change in funds. We have statement of accounting policy. We have explanatory notes to the account, making sense. Let's see what the system here is also telling us. The standard listed the following as a complete set of financial statements: statement of financial position, statement of financial performance, statement of change in net asset or equity. But we don't use equity in the public sector. We use what? Net assets. We have cash flow statement, explanatory notes to the account, and statement of accounting policy. These are the statements that are meant to be recognized in the public sector. Now, what is the statement of financial position is all about? The statement that gives us the details of asset and liability of an entity in the public sector. Let's see what it's talking about. Information to be provided on the face of the statement of financial position. The standard provides the following information should be provided on the face of statement of financial position. What are the things you are meant to do? Property, plant, and equipment. We have investment property. We have intangible assets. We have financial assets, excluding the amount shown under E, G, I, and H. All these are what is going to contain in the statement of financial position. When we are preparing it, we see more of that. We have a better understanding of that. The statement of financial performance, that is being prepared in order to ascertain the surplus or deficit in an organized sector, in the public sector. Under this part, we have what we call revenue, we have finance costs, we have share of the surplus or deficit, of associate where necessary or joint venture, which we are going to look into those one later. Then that is, if someone below are the statement below are the statement of financial position, how it's meant to look like. I just want to give you that. I don't need to go into that. Look at it. This is now in preparing statement of financial position in the public sector. You can use it in, you can prepare it in two ways. You can use cash basis and you can use accrual basis. Now, when you are using cash basis, you start with liquid assets. When you are using accrual basis, start with what? Non-current assets. You need to take note of that. That one is also very, very important. And this one that I'm giving to you here is they start with what? Liquid asset, which means they prepare that on a cash basis. Now, here we have the cash and cash equivalents. We have received receivables, we have inventory, we have prepayment, we have investment. Then here we have what? Non-current assets. And then the receivable, we have investment, those ones that are long-term. Other financial assets, infrastructure, plant and equipment, land and building, this and that. All these, they are referred to that. Then when this comes to liability, we have current liability, we have what we call non-current liability, then we have what we call net assets. This one relates to an entity being operated by the government under the parastatals. Why statement of financial position look like this? We have operating revenue, the tax collected, the finance and penalties. We have revenue from exchange transactions. We have transfer from other government entities. We have other operating revenue. These are the revenue. Then we have what? Expenditure. We have what we call operating expenses. All those ones are also stated condition. Then we have what we call the surplus and the deficit. Other income also being stated clearly. Any question about Ipsas 1? This is a summary of Ipsas 1. What you need to understand are what are the things that make up the financial statement in the public sector. And we said the component of financial statement in the public sector, we have statement of financial position, statement of financial performance, we have cash flow statement, we have net asset, change in net asset, statement of change in net asset. We have what do you call it? Net explanatory notes to the account and statement of accounting policy. All these statements are compulsory in the public sector when you are preparing for publication. Any question? Hello? Hello?
We are with you.
Okay. Now, the next
So are we
statement.
not going to do any calculations on this Ipsas 1?
Speak up, I can't hear you.
Are we not going to do any calculation on it? This is Ipsas 1. Hello, can you hear me now?
Speak
No
up.
practical questions.
Practical question. We are going to solve question. Don't worry, just put down. The reason why I'm taking this, that practical question is under parastatals that I'm taking you to. When we get there, we solve, we now apply all this. Is that clear? Hello?
Okay, sir.
Yes.
Okay, sir. Okay.
The minority interest share of the surplus from the ordinary activity include the non-controlling interest share of extraordinary items. The presentation of the extraordinary items net of the non-current interest non-controlling interest is permitted by paragraph 57 of the Ipsas 1. Disclosure of this non-current interest share of the non-controlling interest non-controlling share of extraordinary item is shown in the notes of the statement. Just wanted to have a of that. Now the next one is what? Ipsas 2. Now, what is Ipsas 2 all about? That is cash flow statement. Ipsas 2 is all about what? Cash flow statement. And what is cash flow statement? It is a statement that shows the cash inflow and the cash outflow. Statement that shows the cash inflow and the cash outflow. Now, these statements we are referring to that we are talking about, it has a component. What are the components of cash flow statement? It has 3 components. We have operating activity, we have investing activity, and we have what we call financing activity. The cash flow from operating and finance investment, they are meant to be recognized in terms of the receipt and payment. When we refer to as receipt, that is when the cash is coming in. And when we talk of the payment, when the cash is what? Going out. That is what we refer to as what? Outflow. All these statements, all these components has their means of recognizing their what we call cash receipt, which is what? Cash inflow, and cash outflow, which is said to be what? The payment. Under each component we are meant to look at. There are 2 methods of preparing what? Cash flow statement. We have what we call direct method and we have what we call indirect method. Under the direct method, we use what we call cash basis to recognize all the inflow and outflow. While under the accrual basis, that one we work back using statement of financial position by comparing the 2 years of account being prepared to know the difference. That is the difference that's meant to be recognized in the statement of cash flow. Now, let's see what this is talking about. Now, this standard requires the presentation of information regarding to the historical changes in the cash and cash equivalent of an entity by preparing a cash flow statement. The statement classifies the periodic cash flow into the operating, investing, and financing activity. IFRS on which the standard is based is IAS 7. Why here we refer it as what? Ipsas 2. Under the IAS, this is recognized as what? Ipsas, what do you call it? IAS 7. Now, what we talk about classification of what? Cash flow by activity. Now, we need to have what? We need to know what are those things to be recognized under the operating and what are those things to be recognized under the what? Finance in terms of inflow and outflow. A part of it says what? Cash flow from operating activities in the public sector entity are indicators of what? Are indicators of the extent to which such entity is financed by tax or sales of goods or services. Example of such cash flow are as follows: received from tax, levies, and fines, which means anything that has to do with what? Levies and fines is meant to be recognized under what? Under the operating, because it's on a regular what? Basis. That is, you normally have that within a year. Anything that has to do with what? On a yearly transaction or daily transaction, they are referred to be what? Operating activity. Is that clear? That is the reason why tax is what normally is on a yearly basis or daily or monthly what basis. Aside that, sales of goods or provision for service by the entity. When the entity renders service, they will need to receive money. In that scenario, they will also need to recognize that as operating what activity. Receipt what? Grants. That is grants being received. We call it what? Recurrent grants. And as with recurrent grants, it's meant to be recognized under the operating activity made by the central government, state government, or local government, depending on the one that is giving the grant. Then we also have what? Cash payment to supplier of goods and services. When there's a supplier of stationery or any other means by the public entity to the by the what private entity to the public, they are meant to recognize as what payment to the supplier. Then that one is cash is going out. That is cash outflow. Then we also have what we call payment to the entire public sector entity, where government transfer money to other what entity. We also have what? Cash received from the royalty, fine, fees. So all sorts of toll fee, commissions, and thereabout, revenue that have been generated. That one is referred to as what? Receipt. We also have what? Statutory allocation. All those ones, they are said to be what? Receipt. Subvention. They are referred to what? Receipt. Now, all this, you are going to see them under the cash flow statement. Then, when they pay the salary, that is personal emolument of employees, is under what? Outflow, and it's under what? Operating activity. Pension is under operating what? Activity. Gratuity is under operating what? Activity. Exactly. All these are meant to be recognized under this part. Local properties and thereabout. That is under operating what? Activity. Now, we move from there down to B part, which is what? Investing activity. This investing activity has to do with what? Acquisition of assets. When the government acquire an asset or they purchase an asset, they construct roads, they construct bridges, all those ones, they are investing what? Activity. They are acquired what? Assets. Money is going out. That is outflow. Then when we talk of disposal of government properties, proceeds on disposal of government property is meant to be recognized as inflow under the what? Investing activity. When there is return on investment, that one is also meant to be recognized under what? Investing activity. Let's see what and what is on the material. Says what? Cash flow from the what? Investing activities are cash received or payment to acquire what? Resources. That are intended to contribute to the entity's future public service and delivery. Public, when we talk of Ipsas 2, it gives the following as likely items that could be classified under such activities. Now, let's look at it. Cash payment to acquire property, which is what I made mention of. Property, plant, and equipment. Intangible asset, that is what? Investment. Other long-term assets. These ones are referred to as what? Asset acquisition, and money is going out. When we talk of receipts from sales of property, that is disposal. Proceeds from disposal of what? Assets. They are meant to be recognized. We also have what? Cash payment to acquire equity is an investment, or debt what? Instrument. When we say debt instrument, that one is also what? Investment. Do you understand? The cash received from equity, debt, or that is what? Interest. I mean, when we talk of what? You invest in a business and they pay you returns. All these are meant to be recognized under that. While under finance, we are talking of long-term loan. Anything that has to do with contract and thereabout, that one is under long-term. Then when we talk of the other areas where we refer to as what? Finance, we are talking of loan receipts, loan repayments. We are talking of government borrowing money from other what? Government giving capital grants to other institutions. All those ones, they are referred to as what? Outflow. It now said, notes, public sector entities are required to present separates all majority classification of gross or such receipts and gross cash payment across from the investment and the what? Finance activity, unless the standard expressly permits report of cash flow on the net basis in accordance with Ipsas. All this when I'm preparing it to see where and what you are meant to understand. All the notes are meant to be cleared when I'm preparing. Now, Ipsas 3 is all about what accounting policy and change in accounting what entity. I have what question to solve under what cash flow, but I want to touch those areas I wanted to touch. If I'm now preparing it, I'll be making reference to those areas. Don't be new to me. Is that clear? Hello? Hello?
Yes.
Now, the next one is Ipsas 3, which is what? Accounting policy. Statement of accounting policy, change in accounting estimate and error. Now, this one is not something that is too much, but you need to have a better understanding. Excuse me. Let me use the rest for you. Okay. I'm back, please. Now, what we are looking at now is what? Accounting policy, statement of accounting policy, and change in what? Accounting estimates and errors. Now, this one, accounting policy refers to the principles that are meant to be adopted, the principle and practice that are being adopted by an entity in preparing its financial statements in terms of the recognition of revenue, expenditure recognition, measurement of accounting transactions, the exchange rate. Are you with me? The depreciation method you have adopted in preparing your financial statement, the accounting basis you have adopted in preparing your financial statement, whether cash basis or accrual basis. All these are part of what are meant to be disclosed in your accounting policy. How do you recognize assets when you purchase it? Do you charge depreciation in the year of assets? What depreciation method are you taking? What is the depreciation rate you are taking? How do you distribute your what? Your income to your investors? All these are part of what are meant to be disclosed in your accounting policy. And prior year adjustment or correction of errors. In the previous year account you prepare, you've committed error that people don't understand. Then in the process, you now discover that you now need to effect that. You need to state that what has happened and the adjustment that has taken place in that what current year compared to the previous year. All these are prior year what adjustment that you need to understand when it comes to what Ipsas 3. Let's look at what the Ipsas is saying. Now, the standard is designed to set out the criteria, to set out criteria for selecting and changing accounting policy together with the accounting treatment and disclosure of change in accounting policy, change in accounting estimate, and correction of errors. The standard gives the following definitions Accounting policy are the specific principles, basis, conventions, rules, and practice applied by an entity in preparing and presenting financial statements. Does this differ from what I've explained? No. A change in accounting estimate is an adjustment of the carrying forward of an asset or liability based on what has error that has occurred, or you have elongated or you repair your asset, and the useful life of that asset is going to change. All these are part of what are meant to be disclosed. Formerly, the motor vehicle you are using supposed to use what, 5 years, but you change some things in that vehicle, and that thing is said to be a capital something. At the end of the day, the period of that asset has what, increased, maybe from 5 years to 10 years. All these are part of policy that are meant to be what, disclosed or reported in your financial statement, telling us the number of years of the asset and thereabout. Now, prior period errors, an omission from the misstatement in the what, entity's financial statement for 1 or 2 periods arises to use or misuse of reliable what, information. All these are also meant to be what, reported as statement of accounting policy is concerned. We also have what we call material omissions. All these are meant to be what, stated. Now, what are the necessary information to be disclosed? Changing accounting policy, changing from one accounting basis to another accounting basis. Maybe you are using cash basis before, then you change from cash basis to accrual basis. We need to disclose that. Is that clear? Is that clear? Nobody is saying anything again. Are we still there? Hello?
Yeah.
Okay. I said when it comes to what, changing accounting policy, you change from what, cash basis to accrual basis, or from accrual basis to cash basis. We need to disclose that in your information also. Then changing in accounting treatment, recognition also needs to be stated. It doesn't differ from what I've explained. That is what you need to have when it comes to what, statement of accounting policy. The following are not changed in accounting what, policy. The application of accounting policy for the transaction, other events or conditions that are different in the substance from the previous accounting. Those ones are not necessary. But what are the things to be disclosed? These are the information to be disclosed in the, as accounting policy is concerned. The title of the standard, when application or an event of the transitional, that is when you change from one accounting basis to another accounting basis. Then the transition time you need to what? You also need to state it when it happens. The transition provision that might have an effect on the future, you also need to state that in the details. Any question, please? As B is concerned, the nature of change in accounting policy is also meant to be the reason why you are changing. You also need to disclose that. For current and the previous what, period, present to the extent of that. You also need to state that. Everything that has to do with that needs to be clearly stated. Those are the information to be disclosed as that accounting policy is concerned. Then Ipsas 4, as the Nigerian system is concerned, the exchange rate is not having much effect on us. For now, I will not discuss this one. I will come back to this one later, discuss. Because this one is not priority. We need to look at the one that is priority first. Is that clear? Hello? I will come back to this note. We will not discuss Ipsas 4. I will come back to it to come and discuss. but not now. Let's look at those that are very, very what? Necessary. I'm coming back to Ipsas 4 later, but not now. Another Ipsas that I also need to discuss is what? Ipsas 11. That one is very, very compulsory. I can't dodge it. Is that clear? Hello. How many of you have idea of contract account? Hello.
Hello, sir.
Hello,
Do
Hello,
we all have
sir.
idea of contract accounts?
No. No, sir.
Now, Ipsas 11 is all about what? Construction contracts, which is relating to contract accounts. If you have idea of contract accounts, you will not have much issue when it's construction contracts. In terms of cost of work done, the value of work done, the cash received, who is the contractor, who is the contractee, how do you prepare the account in the book of contractor, and what do you meant to recognize in the book of what? Contractee. A contract is a long-term contract that could last for 2, 3, 4 years for durable assets or for building or construction of assets. Hello, Mr. Shem. Ó tiẹ̀ ti tàn ọ́ lọ pa lára ògiri ni wọ́n pa ní inú kitchen. Okay, ẹ ṣe. Now, what is the objective of construction contracts as Ipsas 11 is concerned? We need to have an idea of what it is all about. But let me help us summarize what is contract account for you. Contract account is one of the accounts to be prepared by contractor and contractee based on the agreement between the two parties, where the contractor is giving out a job to a contractee who is there to handle the work. There are costs to be recognized by the contractor and contractee. And there is a value of work to be submitted based on the payment to be given by the contractor, by the contractee to the contractor, based on what they agreed, sum of the contract. We have costs to be what? Recognized. The costs to be recognized are those costs incurred in the course of that particular what? Contract. such as what? The material they purchase, the plants they purchase, and other related costs. Maybe there is a sublet of that particular what? Contract to another person to work it out. All these will be what? Added together to be referred to as what? Cost of work done. When that particular person that gave the work to you now okay with those things, they refer it as cost of work done certified. Cost of work certified. The value that you attach to it that say that this is the amount that you are meant to pay at the end of the contract or for the sum of that particular contract. It could be partly payment and it could be a total sum. If it is partly payment that is meant to be given to you, they hold on to some figure until you finish that particular contract, and the contract is meant to be on a stage basis. You are meant to be reporting the cost and the what value of the contract at each stage in order to determine your profit at each stage of the contract. The profit to be reported at each stage of contract is refers to what? Is refers to what? Notional profit. Notional profit is the profit to be reported at each stage of the contract by comparing the cost of work done certified and the value of work done certified. Where there is part of the work to be done, to be carried out, is also from part of the cost, which will be deducted, which is going to be carried out in future. That is refers to as work in progress or cost of work done non-certified. Why the money that you are, they only pay you an advance, they hold on to some money that they didn't pay to you, they call that what? Retention fee, which will be paid to you later. If they now pay you the total sum of the money that you are holding on to and you have not finished the particular work, the difference, you are meant to recognize only the income that relates to the job you have done. Why the money paid to you that you have not done the work, that one is refers to as what? Is refers to as deferred income. It's liability on the contractor. It's asset to the contractee who is giving out the job. This is the summary of what we refer to as what? Construction contract. But let me now give you what is in the what? Material. Let's manage to give it out. The objective of this standard is to prescribe the accounting treatment for costs and revenue associated with what? Construction contracts. Now, looking at it, construction contract, it is a contract or similar bringing arrangement specifically negotiated for the construction of an asset or combination of assets that are closely related or independent in terms of the design, technology, and function or other ultimate purpose. Contractor, it is an entity that performs the contract work pursuant to the construction contract. That is the person that is meant to do the work, which doesn't differ from what I've said. We also have cost plus base contract. The construction contract, which the contractor is reimbursed for allowable or otherwise, defined as the cost and the case of the commercially based contract, an additional percentage of those costs or a fixed fee, if any. Now, what this one is saying is that the cost that you incurred plus certain amount that has been added to it will make up what you are going to claim from the person that is giving you the work. Fixed, the element of that plus that is there may be in the process of acquiring the materials that you are need for that particular contract. The transportation cost needs to be what? Meant to be what? Considered. Other related costs are also meant to be considered, which is part of the charges you have put in place for the contract, for the contractee. That is the cost you are meant to recognize. Anything you incur in the course of the what? Of the contract is recognized as cost. Why the money you received in the course of that particular contract is referred to as what? Revenue. The fixed price contract, this is the contract, this is a construction contract which the contractee agreed to as a fixed contract price or fixed rate per unit of output, depending on what you have agreed on. That is what we call the contract value. Now, let's also look at it from another dimension. Contract revenue. What are the things you are meant to recognize as what? Contract revenue, or something that composites what? That serve as a composition of your revenue as contract is concerned. They said initial amount of revenue agreed in the contract. That's one. They now said B, variation in contract work. Now, what we agree is that I'm going to collect some amount of money from you, 500 million, for me constructing the road from so place to another place. Then in the process, we now look at it holistically, saying that if there is changing in the what, in cost of materials or items, possibility that you are going to add some certain amount of money to this your money is high. In the process, if such should now happen, then the variation will also be accounted for. That variation that leads to additional money being collected, that one is also meant to be recognized as what? Revenue. What are the variations? It is probably that they will result into revenue and they are capable of being reliably measured. As far they are resulted into revenue, they must be able to watch, you must be able to measure it as part of revenue items. That's what that one is referring to. Then the next one is what? Contract what? Costs. What are the things that are meant to be looking at as contract costs? They said what? The contracts, the cost that relates directly to the specific contract. Any cost you incur in the course of the contract. That is what they mean by what? Directly relates to that contract. Costs that are attributable to contract activity in general and can be allocated to the contract on a systematic and rational basis. Such other costs that are specifically chargeable to the customer under the terms of what contract. All these are recognized as part of contract costs. Recognition of contract what? Revenue and expenditure. All these are what you are meant to recognize, which is doesn't different from what we have explained. The total contract revenue, if any, you need to recognize it, measure. It is probably that the economic benefits, that is the profit that is accrued, we also recognize that. Then both contract costs to complete the contract and the stage of the contract completion at the reporting date can be measured. That's why I said contract is always on the what? Stage, and you are meant to report at each stage of the contract, both the cost and the revenue. Then we also have what? The contract cost attributable to the contract can be clearly identified and measured reasonably so that the actual contract cost incurred can be compared with the prior estimate. That is the total cost you incur with what you have estimated. You can compare it and determine your variation, if any. Okay, the information to be disclosed is also meant to be stated. Other one that we stated there doesn't differ from what we have talked about. That's why I ignored those ones. In the case of the cost plus or cost-based contract, the outcome of the construction contract can be measured reasonably with all the following conditions. Now, in this scenario, we have the what? Recognition of what? It is possible that economic benefit or service potential associated with the contract will be flow to the entity. that is any benefit coming, is part of what you are meant to recognize. Then the contract costs attributable to the what contract, whether or not specifically reimbursed, can be clearly identified and measured reasonably. That one will also form part of your cost. Revenue should be recognized only to the extent of the contract cost incurred that is related, that is what probably will be recovered. Cost contracts should also be recognized as an expense. All these are what we have talked about. That's why I don't want to talk about them. Then recognition of expected what? Deficit. When you incur deficits in the course of the contract, is also meant to be what? Recognized. That's what they are telling us. Then what are the things to be disclosed in the contract account? These are the information to be disclosed. The amount of contract revenue recognized as revenue in the period. The amount of the method used to determine the revenue, what you use to determine the revenue, whether you define it or you apportion it, you need to tell us based on the amount you receive, based on the stage of the contract. The method used to determine the stage of the contract, you also need to disclose that. Then an entity should disclose each of the following for contracts in progress at the reporting date: the aggregate amount of costs incurred and recognized plus or less the deficit to that date. The amount of advance received, you also need to tell them. The amount of retention fee. I've told you what is retention fee. Retention fee is the amount they held, that is held in the hand of the contractee till the end of the contract, and the contract is well satisfied. That is when the retention fee will be paid to you. Taking, for instance, they gave you 80% of the sum of the contract. They hold on to 20%. When you finish that work, it's when you are going to collect 20%. That 20% they are holding on to what they call retention fee. Why the money given to you, 80% is the advance given to you. All those ones are meant to be recognized as standard. Then you are meant to disclose any receivable. The receivable, that is the money that is yet to be paid, will be referred to as receivable in the hand of what? In the account of what? In the book of the contract of the contractor. Why in the book of the contractee is going to be looking as what? Payable. But if they pay you the total sum of the money and the job has not been done, the stage of work you have done, you recognize the revenue. The remaining revenue in your hand will be recognized as what? Liability. Any question? Any question? Any question, please? Any question? Any question? Hello? Are we all still there? My people.
Yeah, yeah.
Okay. Oh.
Yeah.
I ask you any question.
Well, yes, sir.
Any question regards to Ipsas 11? Now, the Ipsas 12 is all about what? Inventory valuation and inventory management. Ipsas 12 is all about what? Inventory valuation and inventory management. If you pass through stage what? Foundation, all these will not be new to you because we'll discuss all these in foundation. But let's still look at it because in foundation it is taken at what? We discuss it under what? Under inventory management as IAS2 is concerned. But here it's taken as what? Ipsas 12 inventory. What is it all about? We are meant to look at what make up the inventory, what and what are we meant to recognize as inventory. For a manufacturing organization, it's meant to have 3 inventory as the manufacturing organization is concerned. for a trading organization, is meant to have what? Majorly a one inventory, which is what? Stock that is trading. That is the merchandise. But as a manufacturing organization, it's going to have what we call raw material, it's going to have what we call work in progress, and it's going to have finished goods. That is in line with what Ipsa, in line with what IS2. But as Ipsa is concerned, what we are meant to recognize as inventory is a bit different from that one. Apart from the resale, and biological asset in this scenario is not recognized as direct what inventory as Ipsa 12 is concerned. Now, let's look at it one after the other here. Ipsa 12, this standard deals with the valuation and presentation of inventory in the financial statement. Are you with me? In the context of the historical cost system, the most widely adopted basis on which financial statements are reported, the standard does not deal with inventory accumulated under the long-term construction contracts. The inventory under the what? Under what contract that is a long term, they don't recognize as what inventory. That's what they are telling us. If it is a physical what asset, it's not an inventory. Now, what are we referring to here? It provides guidance on the determination of the cost and its subsequent recognition as an expense, including and written down to the realizable value. Now, we have what we call realizable value. That is, you are meant to sell your asset, your inventory. There's a way we determine that when we compare what the sales expense from the selling price. What you are going to get, the lower of the two, is what we normally use to recognize what? To report and recognize the value of inventory to be reported in the financial statement. The lower of cost or net realizable value. Okay, let's go. Now, they said the IFRS on which the Ipsas is based is on IAS2 on inventory. That is what they are telling us that. They are still using the context of IAS what to discuss that. Okay. Now, we now have, in accordance with Ipsas 12, inventory are assets held for resale in ordinary course of business. They can ask you, what are the conditions for an asset to be recognized as an inventory? Assets held for sale in ordinary course of business. That is, anything you are dealing the business with, that's where you can recognize as an asset. In the process of production for such sales or distribution, to be consumed in the production of goods and services, in forms of material or supply to be consumed or distributed in rendering words of service, held for resale or distribution in the course of operation. All these are the conditions for you to recognize inventory. You are not trading, you are not producing, you just pick up something and you say this is your inventory, it's an asset to you. No. That's what they are saying. If you are the one selling a car, then it is an asset to you as an inventory. But if you are using the car, it is not an inventory. If the car is for your personal use, that one for personal use is an asset to you, which is what? Physical asset under equipment, under Ipsa what? Ipsa 17, which we are going to discuss later. If you are buying land and you are selling land, you can recognize that as what? property, which is under what? If it is you are trading, you are buying and selling land, then you can take that as what? Inventory. But on a good day, you buy land and you are trading land, that one is going to be recognized as a what? Property under what? It's a what? Which we are going to discuss later. Inventory are also goods purchased for resale, such as merchandise, which I made mention earlier. Purchased by retailer and held for resale, or land and other property held for resale. I've made mention of that. Inventory also encompasses finished goods or work in progress and include materials and supply awaiting use in the production process. All these are recognized as what? Part of what? Inventory. Then what are those ones that we don't recognize as part of what? Inventory? We also need to know that. Specifically in the public sector, inventory also comprises goods purchased or produced by the entity that are distributing to the third party for charge or for normal charges. Any example will be child book. Oh, this one, they are not necessary, Janet. But as contract is concerned, that is what they are trying to explain to us here. Other examples of inventory in the public sector given in the Ipsas, including ammunitions, maintenance, materials, spare parts, strategic stockpile, e.g., energy reserve, medical in the government, hospitals and clinics, stocks of unissued currency, stamp, work in progress, and proper held for resale. All these are referred to as what? Are said to be recognized as an inventory in the public sector. That's what they are telling us. Exception from Ipsas 12, those ones that you are not meant to recognize as inventory, these are the ones they are giving to us here. As Ipsas 12 is concerned, work in progress arise under construction contracts, financial instruments, biological asset relates to agricultural activity and agricultural produce at the point of harvest. Work in progress of the service to be provided for, no charges or normal consideration directly in returns from the recipe. All these are not to be recognized. Any question, please?
Go ahead, sir.
Okay. Fine with this. We need to look at the measurements that are meant to be recognized. Ipsas 12 does not apply the measurement of the following inventory. products. Okay. Now, we also look at it from another dimension. Inventory of commodity broker, trader who are measure inventory of fair value, such as what? All these what? All these financial instruments, that is what they are referring to here. They are not known to be what? They are not applicable in this area as inventory, as Ipsas 12 is concerned. That is what they want you to know. Those things are not meant to be recognized as what? Inventory. Biological assets in this scenario are not meant to be recognized as what? Inventory under the Ipsas 12. Now, the measurement. What measurement do we normally take when it comes to what? Inventory. Measurements in line with this, we look at it from the distribution and consumption. Those are the conditions surrounding this. Are you consuming it for production purpose, or they are meant to be distributed for resale at the normal charges or at no charges? When we talk of public sector, for you to have a better understanding of this, government are meant to, let's take for instance, we have what? Stationaries. They will buy the stationery in bulk and keep it. They will be taking it when they need it, and they are meant to be documenting it. Why to some other organizations, they will transfer to them at a cost. Why some at no cost? That is what we refer to as what? At charge or no charges, or normal charges. Then some might be for consumption purpose. Those are the ones we can look at for us to be able to measure what the inventory. Then the cost of inventory, all cost of purchase, that is the cost of the what object you have purchased, is referred to as cost of what? Inventory. The second one is what? The second one is what? Conversion cost. Other costs incurred in bringing the inventory to the present location are also meant to be considered, such as carriage inward or transportation. Those ones, they are part of costs to be considered. The cost of purchase of inventory comprises of what? The purchase price. If it is imported product, we consider the import duties and other taxes. We consider the transportation. holding and other related what direct costs for acquisition of that particular what inventory. Is that clear? And what make up the conversion cost? Direct cost plus fixed production overhead plus variable overhead. What make up the direct cost? You need to understand that under the direct cost, we have what we refer to as what direct material, direct labor, and direct expenses. All those will make up the direct cost of direct variable overhead. And under the conversion cost, what we make up conversion cost? What you use to convert that particular what production, that particular material to finish or semi-finished goods. This is in line with process costing. This is in line with process costing. Under this conversion, under process costing, we have 4 stages to be converted, to be recognized, in order for us to be able to know how much is the cost you have incurred per unit of product. We have what we call statement of what. The stage 1 is statement of what? Input and output. Stage 2 is statement of equivalent units. Stage 3 is the statement of what? Cost analysis. Stage 4 is statement of performance. That is what we normally use under the conversion cost in what cost accounting, which is the application of what we have here. Let's see what they call cost conversion. Then cost of conversion of raw material into includes direct related cost to the unit of production, such as direct labor, a systematic allocation of fixed and variable overhead, and that are incurred in converting the raw material to finished goods. It doesn't differ from what I've explained. Then on the last aspect, fixed production overhead are the what? Indirect costs. While variable overhead is also what? Is not indirect, it's direct cost. Is direct. Variable production overhead is direct cost, but it's not directly related to the unit. That is why they said direct or indirect. They stated it here. It could be direct, could be what? Indirect, depending on the nature of the item. Exception of cost of material in this particular place, which one we are not meant to recognize. Cost of service in this situation, all this abnormal wastage, all these storage costs, we don't consider. Administrative overhead, they are not part of what cost we are going to recognize. Don't recognize that. Cost of inventory of the service organization. Now, the cost of inventory of the service organization, a service provider consists of primary of the labor and other costs of the personnel directly engaged in providing the service, including the supervisory what? Personnel and the attributable overhead. What we're saying here is that there is nothing like direct. The only direct cost or the service organization don't have what? Inventory. The only cost they are meant to incur is the labor that have engaged in that service, which is the only direct cost they are meant to incur. That is what that one is trying to tell us. Then on the last aspect here, which is the what? Cost formula. That is, cost formula in the public sector is refers to the what? Inventory valuation. How are we meant to value the inventory? There are 2 basically methods of valuing inventory in the public sector, not recognition, valuation. We are meant to use what we call first in, first out, and weighted average. Weighted average. These are the method of valuing what's inventory. And I think, do we have idea of first in, first out? Do we have idea of weighted average? You pass through the foundation, all these are meant to be clear. Then another way of reporting inventory in the statement of in the financial statement, we can report it using cost, the lower of what cost or net realizable value. The net realizable value, this is the estimate of selling price in the ordinary cost of the operation less the estimated cost of completion and the estimated cost necessary to make the sales. That is why we said it is what? Selling price less the selling expense. Selling expense or exchange cost. Any question at this junction? Any question at this junction? The next we are meant to look to, but the time is not on our side. This is already to 10. I need to release you guys because you still have another class. I will also need to discuss Ipsas 13 and Ipsas 17 before going back to other ones, which is what parastatals. Ipsas 13 is all about what? Lease. What make up the lease? What are the types of the lease? We need to look at this in terms of finance lease and what? Operating lease. How do we recognize the cost of lease? All these are what we're going to discuss. And Ipsas 17 is all about property, plant, and equipment, which we are going to look at in our next class before we now move back to where we are going. Thank you very much for being part of today's class. See you next class. Thank you. Any question? We are meant to solve questions on all these parts, but I need to explain them and pick up one after the other what relates to it. Is that clear? Hello? Hello?
Hello, sir.
Hello?
It's
Yeah.
clear.
We are meant to solve questions on all these areas I've identified, but I want to explain them one after the other before I will now solve the question. I will now be pointing to the area that this question is coming from. This is what this one
Okay,
is
sir.
talking about. Exactly. But I will still discuss
Okay,
Ipsas. I will discuss Ipsas 13 before moving back to those what area I wanted to solve question. Because possibility that if we finish Ipsas 13 and Ipsas 7 next week, I will solve question on cash. I will solve question on cash flow. I will also solve question on what lease under the what do you call it? There's a question I'm going to solve that going to show all this one after the other that you are meant to have a understanding of what is it all about before we now move down to parastatals. Under parastatals, all the applications of what you need to know, pick them from there and back to that order after the order. Thank you very much for being part of the day class. God be with you all.
Thank you, sir.
Okay, see you next week. I've done how many Ipsas now? About 5.
It's a 4.
We are going to do that, don't worry. That one is exchange rate. Do you understand?
Okay.
Application of exchange rate and how to go about it. But they don't normally set questions, but I will still talk about it because we don't know whether it will be tested in your own time. I will still talk about it. But let me discuss those ones that are very, very important in solving questions. Do you understand?
Okay, sir.
Is that clear? Yeah. Thank you very much. See you next.
Yeah, good night.
Good night.
There's a problem.